Ladies and gentlemen of the crypto space, we're live on a Wednesday, October 11th at 12:15 p.m. Illusions or delusions? I like to think about this a lot. We have a curse of human subjectivity. We create our own stories. The only thing that really exists is data. This goes back to literally the ancient Greeks and Socrates. Socrates talked about objective reality. I'm cursed by a little bit of institutional education. So objective reality is something that we can never process because ultimately any observation is subjective, relative. We are making the observation. So all that really exists is data. So when we're listening to a narrative, even you right now listening to my narrative, my story, it's an interpretation. So is that interpretation an illusion? An illusion is a misperception or a misinterpretation of the real experience, and ultimately it's all subjective no matter what. It's just my observation and what I think is the best way to describe what I'm observing. And obviously a delusion is just false. So obviously we should become better and better at observing delusions. And I think that's become the case over the last couple of years, especially as we've seen shit monetary policy, even from sovereign nations. And people are delusional to think that they are good. They're clearly bad. They fail. They're hyperinflationary. And we've seen that with like the whole Pool 2 narrative back in 2021, so on and so forth. And people were delusional. They're just false in believing it would work in any regard. So we're stuck with hopefully either making good subjective observations or illusions, in which case they're not necessarily real or they're a misinterpretation. And we can only determine the difference between a good story or just an illusion of what is a good story from hindsight, because hindsight allows us to measure the goodness of a narrative. So we're stuck with something that I always think about. We're dealing with these wars. We're dealing with the reality of what Congress is doing with debt, rather what Treasury is doing to fulfill the fiscal obligations of Congress's rule passing. But those are over time. These are phenomena that occur over time. So we project, we speculate, especially what we do when we engage with these markets. But the reality is the most important thing is today. And every day changes. All we can do is look at the data and say, what is occurring today? And then tomorrow, it's going to change. So we understand causality, and that is the mechanic of nature that allows us to speculate, basically. This causes this, that causes that, so on and so forth. And obviously, the further you get down the causal chain of events, the harder it is to speculate and for that speculation to actually prove out. And you could really, summarize that in probabilities and statistical analysis. What is the likelihood of a certain sequence of events to occur? Anyway, I guess the whole point of this entire opening spiel is data and leads us to what the hell is going on today. So a good thing with regard to data is allows us to peer through the bullshit of any narrative about today. So you hear a lot of talking points with regard to the Fed and obviously folks out of Congress, but that's irrelevant, especially with regard to today. They can speculate on the future, but that speculation you could compare to what you're speculating on using the same data you have today. Now, we have good data. Now, we clearly don't have the same quantity of data that the Fed inspects, nor necessarily the competency and the models, or whatever new models they have. The old models are questionable in many regards, but they have a lot of PhDs, a lot of very smart persons. But we're really good at looking at the data that we look at and understanding what it means. At this point, we've come a long way. So this is oil. Oil's at 84. this is a little too short term for my taste. So let's zoom out to the 6-month chart. So there's clearly a symmetrical compression, higher lows, lower highs. It's complicated because it's intertwined into everything geopolitical as well as currency related. This is like the source of all pressure in FX markets, the core of energy. But this triangle compression is fascinating because it's 6,573 days. That's 18 years, give or take. So everyone, big popular narrative right now is the crash, or they're going to print and it's going to go completely vertical. This reminds me of what Stan Druckenmiller mentioned with regard to we could have 10 years of nothing. And I just thought of this recently, like the last day or so, and I found that interesting because that's contrarian. Isn't everyone expecting like just some crazy event? Like it's going to completely crash, or they're going to print $1 trillion, and it's going to go to the absolute moon. So what if it does nothing? What does that mean? Maybe that would be consistent with a soft landing. Maybe they all know that that's going to occur because they're papering over everything and they have all the acronyms they need to ensure liquidity is relatively stable. Who knows? So you're gonna have to inspect on a day-by-day basis, but I guess the point I'm trying to make, this initial point of the stream, is most people think in terms of binary reality. And I agree with that. So I'm very much a binary person. It's going to either go completely down and crash or it's going to go to the moon. But what if it doesn't do much at all? What if it's just boring? And, this chart is quite interesting. And it appears like it would be relatively horizontal and boring, but a lot of shit's going to happen between 50 and 125. That causes all sorts of distortions in currency markets. But I find that interesting. What if markets don't do much? What if literally the S&P is going back and forth 1% for like 10 years? And I was just thinking about that. That's not necessarily what this chart indicates, because there's a big spread between the 40s and the 120s, and that does a lot to the dollar, and the dollar could either release or dry up a shitload of liquidity internationally. But as of right now, as of today, oil was at 80, 86 or so earlier this week. I mean, it topped at 126, which was pretty high, but it wasn't as high as it was back in '08. But that's kind of a pattern we're seeing. Look at that spike to 120s, and it fell, and it creates this ceiling of a triangular compression. And that's kind of something we see right now also in volatility. So if you go over to move, you had your '08 spike, and now you had your spike in January of 23. You also had a spike in 2020, but the point is maybe if you zoom out further, these spikes could get merged if you look at like a 3-year chart or something like that. But you have a spike, so you have your triangular compression to a degree. At least you have your lower high ceiling. So maybe they do get volatility under control by just papering over everything, and sovereign debt for the U.S. just goes completely vertical, and that's kind of what the CBO expects. So what if nothing occurs and it stays relatively calm financially amidst all of this geopolitical unrest, violence, and warfare? What if? Yeah, that's just me being contrarian. But 136 is obviously responding to last week's bond movement, but bonds have been bid a little bit. 10-year was up at 5%. Now it's a wild number. All things considered, we haven't seen that since '07, '08. But the bid here, so there's two things. Oil is going to allow the dollar to come down. Could be a different story tomorrow, but as the dollar comes down, that changes the denominator for international liquidity conditions. Anything that costs a dollar of oil, is now cheaper in a foreign currency because this is a horrible chart. if we go non-log scale, because it retraces, because the foreign currency gets stronger as the dollar gets weaker. That's the whole point of changing the denominator, to get that perspective of the value of foreign currency. So generally, global liquidity conditions can be inspected very granularly, as Mike Howell does, but there's two factors primarily. It's the dollar strength. As the dollar gets weaker, international liquidity has more value, and the capacity for offshore printing, for there actually to be more currency units in circulation. So you have the purchasing power of a foreign currency unit, or you have the quantity of currency units net in circulation that affect global liquidity, and that's how I inspect things from my limited perspective. So as bonds strengthen, you're going to see increased liquidity, and obviously it's a forward-looking indicator. So this coming down is going to indicate collateral prices have more value. And if they have more value, your Ave health factor goes up internationally. So generally, that's the direction we want to see without things breaking. You know, my post here, I mean, this is a good consolidatory post. I guess maybe that's what the point I'm trying to get to here. Oil leads the dollar, which leads global liquidity directly by influencing the denominator. Collateral rally leads liquidity indirectly as global Ave health factor increases. Rates invalidate growth equity. So this is an interesting one this is my narrative. This is what I believe. Whether it's an illusion or a delusion, you can only ever know that in hindsight. And hindsight might actually prove it's actually the case. You know, in a world with 2.5% to 5% interest rates in the first liquidity cycle coming in the next 1 to 3 years, that changes the whole equation of what is investable. At 2.5% to 5%, there's a lot of corporations that aren't going to be having corporate share buybacks, buying back their public stock. So that changes the entire narrative about growth investing. And if you can't get credit because 2.5% to 5% is too expensive, there goes research and development, there goes acquisitions of additional supplies and materials, there goes acquisitions of other companies, there goes expansion plans going, I don't know. You can imagine what happens if you don't have access to credit that you would have used to do things that you can no longer do. So there goes the growth narrative. And it's not because necessarily revenues, GDP nominally looks pretty good, but it's not just revenues that are going to impact the growth narrative. It's if you're not having the share buyback, that is a big part of the growth stock narrative. And value, if you got some stupid equity REIT paying 2.5% to 5%, who gives a shit if you can get risk-free in the government and lock it in? I mean, you get it screwed nominally anyway. So, I mean, really what determines a viable investment is, I'd say, 7, 8, 9, 10, 11, 12%. I've talked about this before. All right. As the share of users dwindles, I'm clearly boring folks with my thesis today, but Dan's in the house. I appreciate you. Can you please share Bitcoin? Zoom into the monthly. So everything that's going on right now for the last 2 weeks, it's nothing. Nothing has changed from Monday's stream. Nothing has changed from Friday's stream. You'll hear a lot of folks that talk on YouTube, and they're talking about technicals and all the bullshit they want to talk about, but they're looking at ridiculous short time frame charts. Look at the goddamn 3-month. You're still below the monthly TWAP. You have an indication, frankly, from the monthly that we're on support. We're above the TWAP. There's a breakout and a retest. I don't see anything going on here, so I bring up the 3-month because the 3-month is inclined. So it would take like 1, 2, 3 quarters more, 3, 4, 5 quarters, like a year of depreciation for this TWAP to start to decline. So that's why all of 2024 is 4 candles on this chart. So what does that mean to me? That means to me, generally speaking, the narrative for next year is the refinancing cycle. So liquidity in the system is going to have to improve, and they got to get tax receipts up to maintain the solvency of the whole game. So anytime in the entire history of Bitcoin, if you were below the monthly TWAP on the 3-month, you were below the TWAP on the 3-month chart, that was a buying opportunity. And then check back 3 months later, on average, your price is higher. That's why if you turn off the price, that's why this chart looks like this. On average, in 3 months from now, the price of Bitcoin will be higher. And if it's lower, check back in another 3 months, the odds are much higher that the price will be higher. So if you buy below this average price, things mean regress to the average price over time. So it's kind of hard for me to do 3 times weekly streams because nothing's going to change. I'm literally looking at 3-month charts, which also means there's nothing to do, and that's okay. That means the entire year, all of 2023, we've been talking about structure of a portfolio, and it's probably not needed to change at all the entire year. And that's really the base case, what we talk about on Discord and what we talked about on the stream. How much have we done this year? What have we bought? Literally like 2 or 3 things, and very slow-moving, methodical type of restructuring or recalibration of the portfolio if warranted. What was it, only 2 things, 3 things? A little bit, bought the Aura position long at the beginning of the year. Maybe that was the end of last year. That's down. Bought the Convex position. How's Convex doing? We got at the 280s. It went down to 240 from Olympus. It bumped up to 320. Now it's back at 260. All right, great. It's volatile. Very nice position. I'm very happy with it. These price charts reset. Reset price scale. All right, lovely. Give it time. It's a locked position. You can't do anything about it. So I like the Bitcoin chart looking at the 3-month. Ethereum looks more or less similar. Ethereum has been a little bit beaten up compared to Bitcoin as inspected in Ethereum price denominated in Bitcoin. Go to the logarithmic chart and you go out to the 3-month. You can note that this is a very interesting time for Ethereum denominated in Bitcoin. This is our first interaction with the 3-month time-weighted average price since April of 2021. Love these high time frame charts because this is rare. And this is pretty interesting for Ethereum. It's kind of a crossroads. And we'll see what happens. But what does the time-weighted average price indicate? Mean regression. And look, we mean regressed to the average price. Now, clearly, this is a short chart. The history, the entire history of Ethereum is relatively short. Look, this is the entire history. So below the time-weighted average price, as you can see here, you mean regress to the time-weighted average price. Now, clearly, the entire narrative was different back in 2021, so you have to take that into account, and that's why it blew off, way deviated to the upside, and mean regress back to the time-weighted average price. Just remember the perspective that I have. The 3-month Bitcoin chart, if your price is below the 3-month time-weighted average price, on average, in the following 3 months, your price point will be higher. On average. I mean, look at back here. 18, you push below, you push back up. You push below, you push back up. You push below, you push back up. You push below, you push. So that's the whole point. Mean regression, directionality. And you really want to get crazy about it, look at the 6-month. So back here before, cycle 16, 17, this is a different world. So you can't really look at that kind of data. So I like this chart. I like where the time-weighted average price starts on this chart because it's really 18 and 19. And look, at even 18 and 19, he only got a mean regression to the 6-month time weighted average price. And look where we are in the Stochk RSI. It's literally a rounding bottom, pushing for a bullish cross. And you didn't even breach the 6-month time weighted average price in 22 and 23. There is no buying opportunity relative to the 6-month other than interacting with the 6-month time weighted average price. On the 3-month, you get a little bit of a dip below it, but you have a chance of it remaining below it. On the 6-month, any interaction, that was your buy opportunity. So this is pretty interesting. We'll see how this plays out over the next decade or 15 years, where each candle is 1/2 of a year. So this is very hard to process from the average human perspective, and everyone will struggle with it no matter what. What the hell does the 6-month time weighted average price look like? It would take literally 3 years for this time weighted average price to start coming down. 3 years of depreciation. So, I like this chart. And this chart is just fascinating, specifically because we're interacting with the 3-month TWAP. If I say time weighted average price one more time in this stream, uh-oh. So that's cool. Equities are literally horizontal. And look, it's fascinating when you look at equities from these high duration time frames. I mean, look at that. Look at that. You can have, why is that lined up like that? Yeah, 21%. I mean, look at the 6-month time weighted average price for the S&P. You could literally have a 21.58% crash. That would be like the stock market's crashing. Yeah, it's a damn mean regression to the time weighted average price. Okay. Things mean regress. So that doesn't really look that bad at all. It kind of looks relatively trivial. And you're literally completely oversold on the time weighted average price, which is fascinating. The Stochk RSI, you're completely oversold. The last time we were this oversold on the 6-month S&P was 0809. Now, we don't have history, maybe a different source of data. This is obviously futures. This is a fascinating chart from the Stochk RSI. Look, it's actually a bullish divergence. We started bumping up, and it's a higher low compared to 0809. Isn't that fascinating? And you can do all those thoughts of whether it's a fraud or not. It's just literally, it's a liquidity projection at this point, post '08. That's the path of liquidity. And that's why, really, all you need to do is look at the damn oil market as a forward-looking indicator on the dollar, and then the bond market as a forward-looking indicator on the global Ave health factor. And that's how it all works. Drew, howdy. Killis in the house. Killis, thoughts on Pulse Chain in general, please, Noah, thank you. Irrelevant. I think that's a decent phrase. It doesn't mean anything. Doesn't offer anything significant. Doesn't offer anything novel. Insignificant. It's just why. Like, there's no contracts on it that are anything that don't exist 1,000 times over. There's no potential connections to anything significant in the real world, from RWAs to, CBDC issuance. It just doesn't mean anything, unfortunately. It's literally just wrapped up in Richard Hart controversy, which is not necessarily a bad thing. Everyone has mixed opinions about him, but lawsuits are complicated. So to me, it's like off the radar. I don't see anything significant that it offers from a functionality perspective. Because you got to remember, everything in DeFi reduces to literally credit, liabilities, money markets, and forex markets. That's it. It's the same. That's all. That's the offering. So there's no difference whether it's on one chain or another. It's just which chain is being used, and money talks. Where's the liquidity? And that's really what like Chris Black talks about is Tether and Circle define the chains that are significant. Because if there's a fork, if USDC or USDT have no value, that chain's irrelevant. So the only thing that and that's why the only thing that matters and really what defines the relevance of a chain is liabilities, is the available dollar liquidity. Because everything you're doing here, the whole point of anyone being here is to acquire money, to make money. So the maximum amount of money that anyone could make from any of these chains is the total amount of dollars that are on the chains. If you sold 100% of all assets, the TVL means nothing. Useless piece of information. All the assets can only be sold for the amount of currency units that are available to buy them. Well, you're buying the currency units, rather. So that's why we look at liquidity so much in the meat space, and that's why we look at liquidity so much in the crypto space, because if you sold 100% of everything on Ethereum, you could only acquire $66 billion, even though the TVL on Ethereum, is $19 billion. Well, that's interesting. I don't know if that's making my point so well. But the point is, still stands. You can only sell for the stablecoins. That's it. So that's why stablecoins really define what a market is, and it makes sense from an emerging market perspective. Those are the amount of dollar liabilities that have been captured and sticky for opportunity within an emerging market, as compared to going offshore to another market to explore opportunities. Hope that helps. Sergio present, Crypto 2, Paul Tudor Jones says he likes BTC and gold here. Is money printing on the horizon? No, I don't think so. The Fed's money printing and fiscal printing, they're printing. I mean, look at Treasury. Treasury is printing. Everything that everyone's talking about, the government printing, they've already done that. They're doing that right now. The amount of printing they've done since the debt ceiling is over $1 trillion. So you're not going to get a different kind of printing next year. What you're going to have, the biggest printing that matters isn't the U.S. printing. It's not another country printing. It's us printing. It's people printing money. That's what drives the economy. And for people to print money, collateral prices need to increase. And they need to remain relatively non-volatile. And that allows us to print dollars. You print dollars when you use your credit card. If you stop using your credit card because you don't want to spend the money and you don't have it, or you're at a limit or some kind, you're not printing money. When you use a credit card, you're printing money. Credit is money. Credit is dollars. That's the psychological barrier that the average market actor needs to overcome to really understand the way this system works. So I don't see the printing that people think will occurring anytime soon. There'll be no public stimulus that completely destabilize the amount of liabilities in the real economy versus the financial economy. Next time around, they're going to do everything they can to keep any expansion of liquidity directly in the financial economy, which will present itself very differently than it did in 2020. So what you want to really see for appreciation is the dollar come down significantly and bond prices go up significantly. And when bond prices go up significantly, that's traditionally the risk-off move where equities are getting demonetized into U.S. bonds. So that's my base case for what we see. I think we see a significant readjustment of U.S. equities. They're just significant depreciation of U.S. equities. Bonds significantly appreciate. The dollar rolls over because oil rolls over, and there goes your liquidity cycle for next year. What the Fed says plays out, or what if there's any word from Treasury what plays out. I mean, generally speaking, I think they would massage that sequence of events. And that's how you get next year's liquidity rally, which they need because they need rates to come down to refinance all the debt that's literally coming due next year. No horn, no tail. High cap USDR is currently depegging. Do you think this is a season of depegs? Not really. I don't even know what USDR is. I think this is a season of survival, which is something we've talked about for a long time. I think this is a season of focusing on the core stuff. And the core stuff is obvious, like, well, I don't even need to mention protocols. You all know the curve stuff. I mean, Frax V3 just came out, and FXS, FRX ETH is probably right around the corner, and all the shit they're doing with the RWAs. I mean, literally, you'd have no need to think about the small stuff or the new stuff. I mean, everything that's core, that's meaningful to crypto has been literally depriced, completely butchered with regard to price point. And it's all what many people would consider the boring shit from 2021, 2022, the old stuff. Why are people playing around with these new protocols? It doesn't really make any sense to me. When literally the shit that has survived is more likely to survive. And that's it. Whatever survives is going to do well in the next cycle when there is improved liquidity conditions and a positive sum environment, given the RWA narrative, real world assets. So real estate's a complicated one, but I think the easiest one is treasuries, and that's like what MakerDAO has been doing with SDI and what Frax is going to be doing. So I think the most important asset really is the treasuries, because it's a collateral, and it will always get paid because the U.S. could always print it and devalue the currency and debase the currency, as Raul talks about. And that's why it works. That's why other countries' bonds don't work as well as collateral unless you're taking out debt and printing liabilities in that denomination. If you're using collateral to print, better make sure that it's in the same denomination. And that's the safest way, which doesn't really make sense with regard to like treasuries will pay you face value dollars upon maturity, and they pay coupon in dollars, but so that's not the case with like Bitcoin and Ethereum as collateral. So that's an interesting consideration. But obviously, that gets complicated. We're talking like a decade down the road when you could use Bitcoin as collateral to borrow Bitcoin because you could buy things in Bitcoin where you have things denominated in Bitcoin. And we're not even close to that. But, I think that's what's really going to be interesting the next cycle is the protocols that facilitate exactly what we saw. I mean, Abracadabra was hot. And the concept of collateralization and the concept of printing a dollar liability. So who's the dollar, the CDP dollar printers? I think that is by far the biggest thing in the crypto space. Who prints the dollars? I mean, you guys know the laundry list, and I don't like to shill shit, so who prints dollars? Literally dollar printers using collateral. So throw real world assets in the mix and maybe you have a narrative for capital inflow, and that's the whole point of this chart right here, is stables. You'll see a positive sum environment when capital's flowing in, and there's plenty of reason for capital to flow in. Either there's ample liquidity, there's a delta and opportunity, and capital flows in, or maybe there's actually an opportunity in the crypto space that you cannot do in meat space, and that has to do with friction minimization, regulatory arbitrage, so on and so forth. So there's big reasons for capital to flow in. How many gold coins does Noah own? 10. I have 10. What do we have? 10. That's about it. That's it. Uh, whatever that means. It's the extent of my diversification. 16 people made it to the end of the stream. I appreciate all of you. Let's wrap it up for today. Wednesday, October 11th at 12:50 p.m. You know, don't do much. Relax. You probably did all the work you needed to do already, and you're probably well positioned. Let time do the work, and there's nothing you could do today that's going to affect or make anything you want to occur come faster. It's just time. So, yeah, JM Bullion on the right. Yeah, yeah, there's a bunch of other places to get gold coins from too. But anyway, tell everyone to subscribe because we'll survive this market and it's going to be fun at some point, be it next year or 2025, but it's coming and I look forward to it and I will pay a premium to see the bottom. So, you know the deal. After party on Discord for the most rational community in the entire crypto space. Link in the description. Enjoy the day. I will see you guys and gals again on Friday. Peace.